Despite the challenges we faced in the year with respect to subdued market participation, practically no returns in equity investment, etc. But we have managed to increase our revenue. Despite all the problems, we have managed to increase our revenues by 14% from 298 crores to 339 crores. Despite our investment in infrastructure scale up, manpower increase in digital team, our costs have more or less remained the same with just 1% increase. It has helped us to improve our profitability by 216%. I am delighted to report the highest ever PAT of 43.6 crore for 5Paisa Capital. We have not just increased our profits, but also expanded our PAT margins from 5% to 13%. It is also important to note that we have started to get the operating leverage because of scale of our business. We have explained in our presentation that we are broadly able to recover the cost, which is both the marketing cost and servicing cost in the first year with some marginal profit. But a substantial increase in the profit margin comes from second year onwards in the same customer cohort. It is also clear that we are enjoying 50% plus EBITDA margin from customers who complete 3 years in our system. Lastly, talking about our online retail trading acquisition of IFL Security, which we announced in Q3 of FY23. The appointment date of acquisition is 1st April 23. We are currently in the process of seeking regulatory approvals, and I am hopeful to complete this acquisition subject to the approvals in this financial year. With that, I end my opening remarks and I open the floor for question and answer. If anyone of you have any questions, please go ahead and ask. Operator, over to you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. The first question comes from Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Congrats on a good set of numbers. A few questions from my side. Firstly, a clarification. You mentioned that the EBITDA margin is 65% in the third year or over a period of 3 years?
Overall. So if you look at the chart, we are saying that broadly someone who has completed 3 years, if you look at calendar year 20, is approximately 48% overall. With second year onwards is 68% plus, 68%.
Okay, got that. Could you break down the 111 crores of allied broking income for me into various major heads?
Okay. So in the allied broking, major part is our MTF ka income, and in our MTF income stands approximately 60 crores, and 10 to 11 crores is the AMC, and 10 to 11 crores is the DPMC, and the rest is the transaction charges. So this is a bifurcation of 110 crores. Yep.
Okay. That's helpful. Okay. And so how would you read the impact of, in case there is a complete transition to ASBA and also the upstreaming of funds? How do you see the impact of both these measures to your business?
So the first is ASBA is yet to get implemented, but yes, the ticket size there is, I think, because it's a UPI-based ASBA platform, so it will be around 5 lakh. So it will impact, the pains of the smaller ticket size customers. See, even today, so that ASBA will not impact much, because even if people use the ASBA, it is for making pains. Even today, and normally pains are done when customers are taking positions or buying delivery. So in most of the case, the money anyways goes to exchange as a part of our pains. The float that brokers enjoy is basically when the customers sell their stock or clear their positions and keep a credit balance. Normally, we have not seen people transferring funds and keeping it idle. So ASBA will not have much impact. On the contrary, it will become very easy for customers to transact, because the success ratios now on the UPI platform is very high. Talking about upstreaming, yes. So right now with the regulatory changes, it will increase our working capital requirement, because with just very recent circular, the bank guarantees on the customer funds is not allowed. So that will increase our requirement of working capital by approximately 125 crore. But right now, for our current requirement, we are internally well capitalized to handle that requirement. So for now, that will not have much impact.
Okay. So, but when you're selling, when you mentioned about ASBA, that the money is generally lying when the individual sells the stock and the money lies with you. But that will now have to be upstreamed, right?
Yeah, but the upstreaming to clearing corporations are also allowed in the form of fixed deposits. So then brokers will still continue to enjoy the interest on the fixed deposit. Though anyways, a significant portion of the customer funds that are there are anyways parked with exchange, almost to the tune of 85 to 90%. Is anyways parked with exchange in the form of deposits and bank guarantee deposits. But that will continue. That 90% will practically become 100%. But it's not that the income is going away, because exchange has even now allowed brokers to upstream the money in form of cash collateral, also in the form of fixed deposits.
And when you say working capital requirement will go, what will be the cost for that? Approximate?
So right now, as I said, that there will be a marginal cost increase. Yeah. Gaurav will take this question.
So there is a 125 crore or 130 crore will be a requirement. So there can be an increase in costing, but that will not be much on that. It can be 4 to 5 crore.
Okay, you're saying working capital increase will be of 125 to 130 crores.
Yeah.
Okay. Got that. And with regards to this IFL customer transition, obviously you would have looked at the kind of ticket sizes and what is the kind of nature of these customers in the sense. So are they kind of relatively better than what customers or what experience you have with the existing customer base, or would they be similar? How would you look at them more qualitative and quantitatively?
So see, broadly, with this transaction, we are getting approximately 15 lakh plus customers as a part of the acquisition. Now, so these are not like selectively chosen customers. They are a part of an online retail trading vertical of IFL Securities. So the nature of the customers, the behavior of the customer cohorts in terms of geography, age bracket, gender, more or less are same, what our customers are. But then the classification at their end is someone who has 10 lakhs and less margin. So that's the reason, because there was a cap and in this particular vertical, the behavior in terms of ARPU of the customers may not be same as of 5Paisa. It will be a bit less. But overall, the behavior pattern in terms of all the other parameters is more or less the same.
Got that. So from a outlook perspective, this is the last question from my side. There has been so much talk about F&O activity of retail participants being on the higher side. So firstly, can you quantify the breakup of revenue in the brokerage side and how much is from futures and options, between futures, options and cash if you can? That is one. And secondly, what are the measures that the regulator can really implement if they want to kind of constrain this increase in activity?
Sure. So broadly, if you look at the breakup in terms of brokerage and derivative, close to 75%, 80% is the revenue that in today's market condition that we are getting from derivatives. So it's broadly skewed towards derivative as of now. One of the reasons is obviously higher participation of retail and derivative, but it's also a very, very low participation in the cash segment. So, but yeah, currently it is in that range. Secondly, see, there have been talks in terms of the higher retail participation. But you see, if you look at numbers, and this is my my analysis of this entire thing. If you look at the real turnover, which is typically the premium into quantity, on the retail side of it is not more than the overall derivative turnover is not more than 50,000 crores, which is typically the same turnover that cash market segment is generating. So the actual turnover in the retail, which is option trading turnover, is equal to the cash market turnover. Having said that, yes, there has been an increase in the customers who are trading in derivative segment, but that has also because of the changes in the regulatory environment in last 2-3 years. A lot of people used to trade in the cash segment before 2021. That entire customer base, which was trading in cash segment, also shifted to derivative because cash segment leverage went away. So in cash segment earlier, brokers used to provide at least 10 times, 12 times leverage. Now that has gone. So where do you get 10 times? It's typically Nifty, because Nifty margin is in the range of around 8 to 9%. So that's where you get leverage. So that customer shifted to derivative. Second, the overall demat account number actually from 3.5 crore, we are at 11 crore demat accounts. So when you have more retail participation coming in overall capital market, the numbers will go up. Though, yes, there has been advisory, there have been, reports, and SEBI has also published a report in terms of how many people are making losses. But I think it's a general, behavior. Today, the leverage has gone out of system. Brokers can't give leverage. Customers have to come with complete cash. There is absolutely transparency. So I think a lot of measures are already done. What more will be done is something that we'll all have to, see. But, I don't see that this as such a dangerous trend that is being perceived otherwise.
Thank you so much. All the best. I'll come back in a few.
Okay. Thank you very much for that.
Thank you. Next question comes from Deepak Sonawane from Itong Securities. Please go ahead.
Hi, sir. Am I audible?
Yeah, hi. Yes, absolutely.
Yeah. Congrats for the good set of numbers. So my first question is on cost of acquisition. So we have seen, quarter-on-quarter, and again for industry as well, quarterly average acquisition run, client acquisition run rate is slowing down, right? But for us, if you see that cost of acquisition has gone up, right, quarter-on-quarter as well. That is mainly because of you're saying other OPEX, right? So what, major item that classified as other OPEX, we have reported around 296 rupees per client other OPEX for Q4FY23.
Typically what happens is that, because other OPEX also means the call center, our sales team, which is, part of our call center team who assists customers in opening account. Now, that is a fixed cost of people, and that cannot change immediately with the quarter. So if there is some drop in the acquisition for a quarter, obviously the fixed cost of employees, if you divide by the number of customers, that increases. So I think that's the impact on the acquisition, which I feel is just a temporary thing. Broadly, in my previous calls also, I have said that we've been working on reducing our CAC, and more or less that activity is over. And then I somewhere see that our CAC will range between 500 to 600 rupees, depending on sometimes the market scenario in terms of acquisition, sometimes the composition of acquisition that we are doing in terms of paid performance, and also the organic growth and the referral. So broadly, this will be the range. A small here and there is only because of the fixed cost of employees and the other office expenses that we have.
Okay. But on marketing side as well, we have seen some kind of uptick, right, on quarter-on-quarter basis from 256 to 317.
So there will be a small 50-70 rupees movement that will keep happening here. But broadly, the trend will be in the same range. So if you look at our last 6 quarters performance, we were in the range of around 750-800 rupees, and from that range we will be in the range of around 500 to 600 rupees. So you should consider that as a broad range.
Okay. And my second question is on, a cash position on balance sheet has reduced drastically, right? Year on year, from 89 crore to almost around 21 crore. And as against our borrowings, even, the same pay, they have gone down, right? So any particular reason, major reason for this cut?
Okay. So the cash and cash equivalent, you should always see with the bank balances, because it is one is the FD format, one is the liquid cash. So if you combine together, it has gone up. And cash and cash equivalent is just a balance sheet date ka figure, that how much cash you are keeping to the exchanges. Okay. Second question is related to the borrowings. Actually, the borrowings is majorly related to the MTF book. So you can see our loan book, which is coming down from 250 to 172 crore. Major impact we have seen in the month of March, and hence the borrowing has been reduced.
Okay. Yeah. Thanks.
Thank you.
Thank you. Next question comes from Kajal Ji from ISEC. Please go ahead.
Hello, hi. Congratulations on good set of numbers, sir.
Thank you very much.
Yes. One was on this. Can you just explain more on this slide number 12, where you have shared this first year, second year, third year? And second was on the increase in turnover which we have seen sequentially. So is this led by increase in number of orders or ticket size per order? What will be the color of that? Yeah, those were the two questions.
Kajal, I'm sorry, but I could not get your question very clearly. If you can repeat both your questions, we can answer one by one. What was your first question?
First was about, I wanted to ask the slide 12. So I wanted to understand more on this slide 12, what we are explaining out here. And the second was whether the increase in turnover, essentially what we have seen, is led by rising orders or rising ticket size.
Yes. So I think the first question was related to the customer cohorts that we have shown and the high LTV, right? That's the question.
Right.
Yeah. So what we are trying to show here is that, see, whenever we acquire customers, there's an acquisition cost and then there is a servicing cost. Basis that, what is the revenue that what is the profitability that we achieve in every year? So if you look at calendar year 18, then that customer set has completed 6 years with us. 5 years with us, and this is the CY23 will be the 6th year. So in 5 years, what is the margin that we are getting and subsequent years, and how much are we earning from that customer on an overall basis in 5 years? So if you look at the idea of sharing this was that broadly in the first year, barring last 2 years, because we were investing heavily in technology and infrastructure, you will see a first year negative returns in terms of losses. But broadly we are seeing that in the first year we recover the cost both in terms of acquisition and also servicing, and post that there is a high profit margin gain. And we are clear that if at all customers are there with us for 3 years, the margins will increase. Now this also means that going ahead, because of the steady state of business, our overall margins of the business, which our PAT margin stands at around 13% today, will continue to increase over a period of time. So the whole idea of getting the operating leverage in a model where at some point your cost gets fixed and then it's only incremental revenues which increases your profitability. The idea of this was to show that. Now, second point about the ADTO. The rise in ADTO is a combination of 3 things. One, it is increasing number of customers, which also translates to increasing number of orders, and also the ticket size. It's a combination of both that we are seeing an increase in the overall ADTO sequentially.
Thank you very much.
Thank you, guys.
Thank you. Next question comes from Rishikesh Oza from Robo Capital. Please go ahead.
Hello, am I audible?
Yes, yeah, Rishikesh.
Hi, sir. Thank you for the opportunity. So my first question is regarding the brokering rates. So how do you see the broking rates to evolve going ahead, given that the compliance cost will be increasing and the floating income would be reducing?
See, I have said this in the past also that the kind of regulatory changes which are coming, it is increasingly getting difficult to maintain margins in business. As of now, till date, the changes which have been proposed is not having a significant impact on the cost, and that's why brokers are able to provide a 20 rupee per order. But incrementally, if there will be an impact on the incomes that we generate, for example, the treasury income that we generate on a deposit, if there is an impact on that, or if there is any other impact which leads to a reduction in the derivative turnover, or any other change brought in by regulator, then obviously the cost of running business is, as it is fixed, we will not be left with any choice but to increase brokerage rate. So I think that may not be next couple of quarters, but post that there may be a probability, and there is a higher probability that the rates may go up.
Okay. And also, sir, what is your customer acquisition for FY24?
We acquired close to 7.5 lakh customers in FY23.
And for
are you asking for projection for this year?
Yes.
So I won't be able to give you an exact number, but we will be in the range of same 7.5 to 1 million kind of a customer.
Okay. And also my one more question, sir. What is the other operating income of 18 crores?
So this is again that float income, that
treasury
income. Yep.
Oh, okay. And also, if you could provide any metrics on daily active users and monthly active users.
I'm sorry, we don't share that data.
Okay. Okay, no problem. Thank you very much, sir.
Thank you, Rishikesh.
Thank you. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. We have a follow-up question from Deepak Sonawane from Itong Securities. Please go ahead.
Hey, hi sir. Thank you for the follow-up. So I have only one question, especially on our LTV. The calculation that we have shown in slide number 12.
Yeah.
So instead of if you look at, let's say, if you can give us any color on, let's say, for a CY18 on the first year, the client generated almost around 100 rupees ka revenue. So for subsequent years, what would be that revenue? Because 14% EBITDA margin would be mainly impacted by CAC, right? But if we just look at our revenue, gross broking revenue, so what would be that trend?
See, it will be difficult to give the exact number for each year because our acquisition numbers and the quality of acquisition for each year was different. So the purpose of showing this was that if at all a customer is generating 100 rupee in overall tenure of his life cycle, if I look at the cohort of CY18 customer, then we are talking about that all put together we have only spent 34 rupees in servicing, acquiring plus servicing, and we have got 66 rupees as the income. Now it also means that because we are with every incremental year the life cycle of customer is also increasing, the overall impact of that on our overall business will be high going forward. So one is that the inference of from this data should be one that post 3 years the margins of a customer is 50% plus. Second, with every incremental year, because customers are retained and they trade, the overall impact on the revenues and profitability will be higher, and the margins will improve.
Okay. So just one question. So let's take an example of CY22. So for CY22, first year, the particular revenue, customer has generated almost around 100 rupees. So for CY22, the second year would be, the revenue generated by the similar customer would be upwards of 80%. Will that be an fair assumption?
Yeah, in the span of, if you check the span of, 6 years, yes, you are right. It is coming 70.
But for calendar year 22, we are getting a 69% margin in the second year. So in the second year, we only have the servicing cost because acquisition cost is already gone in the first year.
Right. Okay. Thanks a lot.
Thank you. We have a follow-up question from Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi sir. Just a question on the cross-sell income that has grown by just 5% in the current year in FY23. How do you kind of see this growing ahead, and what was the reason for the slow growth?
See, right now, our focus has been more into our broking business because I said that our product revamp, our investment in technology, all was targeting the broking revenue. So as an organization, the focus was on broking, and that's the reason cross-sell is more of a small enabler of the product, but it's not a major focus area for us now. Having said that, yes, we are planning to introduce lending products and bond and other some fixed income products on our platform. But those the other cross-sell income products do not contribute substantially to the overall income. But broadly, the reason why there is just a 5% growth is because the focus was more on building our product on the broking side of it.
Mm-hmm. And how would you see a margin funding book growing?
So, see, margin funding book growing, typically is directly correlational to the cash market turnover. So as of now, we've closed around 270 crores for last quarter, and because the market scenario is very subdued, the growth is not there. But I think it will increase as and when the market increases.
Okay. And just coming back on this chart on the 12th page, okay. For example, if I look at the third year margin, okay, which is a light blue box, okay, or for that matter, even the yellow box, the second year margin, right? That margin has been declining except for the second year's number, which kind of jumped up in CY22. But if I look at the blue box or if I look at the pink box, they have been declining in each of the years. While there is no customer acquisition cost out there is primarily servicing cost there. Then why is the margin kind of sloping downwards for all these periods?
See, one factor and interesting observation one factor where the margins is a bit reduced as compared to the customers that we acquired in calendar year 18, 19 to 20. So the reason is scale. Because in the first 2 years we acquired, we were only at around 3.5 lakh as a customer base. But in just last 2.5 years, from 3.5 lakh, our customer base increased to from 3.5 to 35 lakhs. So that's a massive increase in our customer base. So what happens is that when you acquire a large number of customers, the quality of the customer is not the same as you were acquiring earlier. And that's why it will have an impact on the margin because typically the cost of servicing is the same. But the revenue that customer brings in varies. And that's why you see a drop in that.
Okay. And so in a way, you're seeing from next year onwards, with your focused approach on acquiring more quality customers now, these margins should improve, right?
Absolutely.
Okay. Got it. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Ladies and gentlemen.
Operator, you can end this?
Sure, sir. There are no further questions. Now I hand over the floor to the management for closing comments.
Thank you very much, everyone, for joining our conference call. If you have any questions, you can write to us at ir@5paisa.com. We'll be more than happy to answer your queries. Thank you very much, and have wonderful holidays ahead.
Thank you, sir. Ladies and gentlemen, this concludes the conference call for today. Thank you for your participation and for using Doorsabha's conference call service. You may disconnect your lines now. Thank you and have a good day.